Okay, let's unpack this because if you just pull up the broad market headlines today, I mean, everything is just flashing green,
Oh, yeah, completely green across the board.
right? Like the Pakistan Stock Exchange is up an incredible 26% for the year. It just looks like this booming, unified economy where, a rising tide is lifting absolutely every boat in the harbor.
Well, the broader index is literally designed to tell you that simple story. I mean, it averages out all the underlying chaos and just gives you a single comforting number to look at.
Exactly. But when you actually open up the 4-hour technical charts
Yeah.
and really look under the hood of that machine, that unified picture just completely shatters.
It really does. It's fascinating.
Yeah, we're seeing the biggest energy giants in the country basically clinging to these technical support lines just to avoid a free fall. But at the exact same time, you've got obscure property tech stocks breaking mathematical limits. So we are looking at a market landscape today that is completely fractured.
Oh, it is the absolute definition of a fragmented market. We are basically seeing two entirely different realities playing out on the exact same exchange on the exact same day.
Which is wild. So welcome to today's deep dive, everyone. We have a really fascinating stack of financial snapshots in front of us. Today is August 3, 2026, and our mission today is to decode a series of technical 4-hour stock charts from the PSX, the Pakistan Stock Exchange.
Yeah, and the goal for you listening is to basically translate what looks like a chaotic mess of red and green candles into clear, readable market sentiment. Whether you day trade or just want to understand momentum, we're going to break it down.
Right, because to a lot of people, these charts just look like static on a screen.
Exactly. But what's fascinating here is that technical charts are essentially human psychology graphed out over time.
I love that way of putting it.
Yeah, I mean, when you strip away all the financial jargon, a chart is just raw fear and pure greed captured in visual form. Every line of support, every sudden spike in volume, it represents a localized battleground.
Like buyers and sellers literally fighting over the fair value of an asset.
Precisely. And by zooming in on a 4-hour window, which is what we're doing today, we filter out all that minute-by-minute noise from the retail day traders, so we actually start seeing the heavy footprints of institutional capital.
Big money. Okay, so let's start by looking at the macro view. The overarching KSE 100 indices chart.
Let's do it.
The top line numbers here are just staggering. The index sits at 178,200.02. It is up 2,105 points just today.
Which is a huge move for a single session.
Right, that's a 1.20% jump in one day. And if you zoom out to the one-year change, it shows that massive 26.35% gain that I mentioned earlier. So to a casual observer, the market is just a rocket ship.
And honestly, a 26% gain in a single year represents a colossal influx of capital.
Oh, absolutely.
That kind of upward pressure usually points to overwhelming macroeconomic confidence. You've got institutional funds, foreign investors, they're all pouring money in, aggressively lifting the valuation of the top 100 companies.
Okay, but I have to interject here because I'm looking at another number on this exact same page that tells a very, very different story.
The year-to-date numbers.
Yes.
Yeah.
Because despite that massive one-year gain, the year-to-date change, so from January 1st to today, August 3rd, it's only a modest 2.38%.
Right.
Wait, you're calling this a massive influx of capital? But the YTD data says we've basically been flat for 8 months. I mean, is this market actually just a marathon runner who sprinted the first 20 miles last year but has just been jogging in place since January?
That is a really great analogy, actually. And if you look at the 4-hour KSE 100 candlestick chart itself, it perfectly visualizes this exact behavior.
How so?
Well, the chart shows a market that experienced a pretty sharp recent dip, and then it's followed by the strong current recovery we are seeing today.
Right, it's attempting to push past that key resistance level, right around the 178,365 mark.
Exactly. But the broader context reveals that the market made all of its massive strides in late 2025.
Okay, so what happens when a market runs that hot, that fast? Like, why hasn't it just crashed back down to earth if it's been stalled for 8 months?
Because of how large funds actually manage their portfolios. I mean, when a massive influx of capital drives a 26% gain, the market eventually has to digest that meal.
Right, it can't just go up forever.
Right, institutions aren't just going to keep buying blindly at record highs, but, and this is key, they also aren't liquidating their positions either. They spend months consolidating those gains.
So they take profits on some stocks, buy the dips on others.
Exactly. They are basically setting a new, higher floor for the market. So that modest 2.38% year to date, that isn't weakness. It's mechanical stabilization. The buyers and sellers have reached this temporary equilibrium at a brand new altitude.
Okay, a higher floor. I like that. So if the broader market is just parked at this new altitude, let's actually look at the foundational sectors where that capital is resting.
Heavy lifters.
Right, because traditionally in the PSX, heavy building materials are where you park your money. It's the literal foundation. So we have two charts here from the cement sector to look at. DGCon Cement, or DGKC, and Lucky Cement, LUCK.
Yeah, to understand what is keeping this overall index elevated, you absolutely have to track this foundational money. Let's look at DGKC first.
Okay, so DGCon Cement is currently trading at 215.59. And looking at the chart, it is moving inside a very clear upward channel.
And we should probably define that for the listener for a second.
Yeah, totally. So an upward channel isn't just a general trend, right? It's a very specific pattern where the stock is bouncing between two parallel upward sloping lines.
Exactly. It hits the top line and drops, then it hits the bottom line and bounces right back up.
It honestly looks algorithmic.
Well, that's because it often is algorithmic. I mean, when a stock enters a clearly defined upward channel like this, trading bots and quantitative models recognize the pattern immediately.
Oh, so they just take over the trading?
Essentially, yeah. They automatically place limit buy orders at the lower bound and sell orders at the upper bound. It creates this self-fulfilling corridor of momentum. But we do have a pretty major warning light flashing on DGKC right now.
The indicators?
Yes.
Yeah.
Its stochastic RSI is pushing a highly overbought 89.89.
Right, and meanwhile, before we dig into that RSI, let's look at Lucky Cement, LUCK. It's trading at 449.49. We recently saw some extreme volatility there.
It's very extreme.
Yeah, the chart shows these massive candle wicks, like these long lines extending way above or way below the main body of the candle. But it appears to be consolidating now, around its support near 438.24.
And those wicks are crucial to understand for anyone looking at these charts, because a long wick pointing downward means that during that specific 4-hour window, sellers aggressively dumped the stock and drove the price way down.
But then it didn't stay down.
Right before the 4-hour period actually closed, buyers just flooded in and bought up all that cheap supply, driving the price right back up to where it started.
So it reveals hidden demand.
Exactly. Hidden aggressive demand. Every single time LUCK dips, there is institutional capital just waiting there to snap it up.
Wow. Okay, I want to pivot back to DGKC for a moment, though, because the indicators on this chart seem entirely contradictory to me.
How so?
Well, the regular RSI, the Relative Strength Index, is sitting at 48.31. I mean, that is the definition of perfectly neutral. It's dead center.
Right.
But the stochastic RSI on the exact same stock is at almost 90. So how can one indicator suggest the stock is just coasting at the speed limit, while the other indicator is screaming that the engine is overheating?
This gets to the absolute core of technical analysis mechanics. It's because they are measuring two fundamentally different things.
Okay, break that down for us.
Sure. So regular RSI measures absolute price momentum over a set period of time, usually 14 days. So an RSI of 48 just means the magnitude of its recent gains and the magnitude of its recent losses are roughly balanced out.
Okay, so it's absolute momentum. If we use a car analogy, the car is going 50 miles per hour, which is a completely average, normal speed.
Exactly that, just an average speed. Stochastic RSI, however, measures momentum relative to its own recent historical range.
Oh, relative to itself.
Right. It applies the stochastic formula to the RSI values themselves. So instead of asking, how fast is the car going compared to all the other cars on the highway, the stochastic RSI asks, how fast is this specific car going compared to its own average speed over the last few blocks?
I see. So even though DGKC isn't rocketing up in absolute terms for its own recent quiet history, it is suddenly sprinting.
Yes, DGKC is moving really fast for its own recent standards. It is pushing the absolute upper bounds of what it normally tolerates.
And because it's trapped in that algorithmic upward channel we talked about, an 89.89 stochastic RSI raises a pretty big structural question.
Exactly, because it's approaching the top of its channel resistance, which currently sits right around 222.41.
So it's about to hit the ceiling.
Yes, and when an asset is this overbought relative to its recent history, it usually suggests the buyers who have been fueling this current run are running out of capital. They are exhausted.
Which means the stock is primed to bounce off that ceiling and head all the way back down to the bottom of the channel.
That's what the math is suggesting, yes.
Okay, so the cement stocks are doing the heavy lifting to keep the market's gains intact, even if the buyers are starting to breathe a little heavily. But, a functioning economy requires a lot more than just building materials.
You need energy.
Right. You need fuel and
Ugh.
you need transport. And when we transition to the energy and transport charts for today, I mean, the capital seems to be fleeing completely.
It's a stark contrast. We are moving from sectors that are absorbing capital to sectors that are just bleeding it out. Let's look at Pakistan State Oil, PSO.
Okay, so PSO is trading at 349.25. And looking at the chart, it didn't just dip, it broke entirely below its long-term ascending channel.
Yeah, the algorithms aren't keeping it afloat anymore.
Right. Now it's just relying heavily on this one horizontal support line down around 341.80.
And you have to remember, a support line isn't a magical floor.
It's not a concrete wall.
No, it is simply a price level where a massive cluster of limit buy orders happens to be sitting in the order book. Every time the price drops to 341.80, those orders execute and naturally push the price back up.
But if we think of a support line like a trampoline, the more you bounce on it, the more the springs stretch out.
Yes, exactly. And eventually, the trampoline loses all its elasticity. Every single time PSO hits that 341.80 mark, it eats through some of those waiting buy orders.
Oh, because once an order executes, it's gone.
Right. And if the selling pressure continues, eventually all those buy orders get filled, the support completely vanishes, and the price just falls right through. The safety net breaks.
Man, that's precarious. And Gandhara Tire and Rubber, GTYR, is facing a really similar existential threat today.
Yeah, their chart is looking incredibly stressed.
It's trading at 33.30, and it is riding the absolute razor's edge of the bottom of its upward channel. I mean, it is one strong sell-off away from breaking its structural trend completely.
And then we also have Ghani Chemical, GCIL, which is telling a totally different story of just pure stagnation.
Right, it is completely sideways. It's trapped in this range-bound box between 33.06 and 40.54, currently sitting at 37.20.
Yeah.
So when a stock is range-bound like that, with just no clear upward or downward trajectory for weeks, what is actually happening in the order book? Like, who is trading that?
Well, it means there is no human conviction left. There's only algorithmic equilibrium. Market makers are essentially just playing ping pong with the stock.
Just bouncing it back and forth.
Right. They buy near 33 and sell near 40 over and over. And the stock will go absolutely nowhere until a fundamental catalyst like an earnings report or some macroeconomic shift forces buyers or sellers to suddenly and aggressively alter their valuation of the company.
Okay, so let's put this all together. If the overarching KSE 100 index is up over 2,100 points today, but heavy industrials and energy stocks like PSO are breaking their trend lines and testing the limits of their trampolines, we have a blatant contradiction in the market.
On a massive divergence.
Right. Like PSO is struggling right now just to break back above a previous resistance line at 352.67. It hit its head there and got rejected hard.
And what you were witnessing on these 4-hour charts is the actual mechanical footprint of a massive institutional rotation.
Rotation of capital.
Yes. The big players, they don't just dump all their shares of Pakistan State Oil at once, because doing so would crash the price instantly and just destroy their own portfolio value.
Obviously.
So instead, they sell into the minor rallies. Every single time retail investors push PSO up slightly, the institutions offload a huge block of shares, which creates that exact rejection at 352.67 you just mentioned.
Oh, wow. So the money isn't actually leaving the Pakistan Stock Exchange, which is why the top-line index is still flashing green. It is just quietly abandoning energy and heavy chemicals.
Exactly. Institutional money never just sits in cash for long.
Yeah.
When it exits a foundational, heavy industry like oil, it immediately goes hunting for high-growth momentum somewhere else.
Which brings us to the next stack of charts, where that fleeing capital is very clearly finding a new home, because the technology and property sectors today are mathematically exploding.
This is the other side of that divergence. The contrast is just staggering. Let's look at Pakistan Telecommunication, PTC.
Okay.
It is cruising upward at 72.50 right now, and its stochastic RSI is a blistering 93.21.
And TPL Corp, TPL,
Yeah.
showing a similarly aggressive breakout. It's trading at 21.40, and it just completely smashed through its previous historical resistance levels at 16.19 and 18.24. I mean, it didn't just test those ceilings, it obliterated them.
It really did. So while oil is struggling to even find a floor, tech is basically discovering it has no ceiling. But we really need to analyze the specific mechanics of how these breakouts actually occur.
Let's do that, and let's do it with the wildest chart in this entire stack, TPL Properties, TPLP.
Oh, this chart is unbelievable today.
It's crazy. We are looking at a sudden, violent price spike straight up to 14.71, and at the bottom of the chart, there's this green volume bar the size of a skyscraper.
Huge volume.
Yeah, and the regular RSI is high. It's nearly 75. But the stochastic RSI is at exactly 100.0.
A literal mathematical maximum. It mathematically cannot go higher.
Okay, I have to challenge this, though, because a stochastic RSI of exactly 100 sounds completely unsustainable. I mean, to an outside observer, a chart with a maxed out momentum indicator just looks like a pure, retail-driven bubble fueled by FOMO, the fear of missing out.
That's what most people think, yes.
Right, the instinct is that a stock sitting at 100 on a momentum thermometer has to immediately crash tomorrow. So how should you actually interpret a stock that has basically broken the scale?
Well, it is a very common misconception that 100% means an immediate reversal is coming. You really have to look at what the math is actually calculating under the hood.
Okay.
A stochastic RSI of 100 simply dictates that for this specific 4-hour window, buying pressure has utterly devoured all available selling pressure.
Wait, the sellers just evaporated.
The sellers didn't evaporate. Their orders were completely consumed. Think of the order book as a literal stack of sell limit orders, right?
Yeah.
You have people willing to sell at 13.80, some at 14.80, some at 14.50.
Right, stacked up.
Exactly. When a stock hits a stochastic RSI of 100, it means aggressive market buy orders came in and systematically bought every single share available at every single price point, all the way up to 14.71. They cleared the entire ask side of the book completely out.
Or couldn't a mob of retail traders, like coordinating on social media, do that? Couldn't they create a temporary, fragile bubble?
They could, and that is exactly where the volume bar becomes the most critical piece of data on your screen.
Ah, the skyscraper volume.
Yes. If a stock hits a stochastic RSI of 100 on low volume, then yes, that is fragile retail FOMO. It can collapse the exact moment one large holder decides to take profits and sell. But
Right.
TPL Properties did this on massive structural volume.
Meaning it takes serious cash.
Right. Retail traders, no matter how well coordinated they are, generally do not possess the sheer capital required to create a single 4-hour volume bar of this magnitude without leaving massive gaps in the order book.
And if we look at the recent history on the chart, TPLP was actually trapped in a very tight box recently, just bouncing between roughly 11.00 and 13.69 for quite a while.
And today, with that skyscraper volume bar, it completely shattered that 13.69 ceiling. This kind of heavy, concerted buying action indicates institutional capital entering the fray.
Big money arrived.
Exactly. Someone with incredibly deep pockets stepped in today and absorbed all of the available supply. When a breakout happens with institutional volume like this, a maxed out stochastic RSI isn't a warning sign of an impending crash.
It's not.
No, it is mathematical confirmation of a fundamental shift in how the market values that asset. The big money just repriced TPL Properties in real time.
Wow. What an incredible journey through a single day in the markets. We've really unpacked August 3, 2026 on the PSX today. And I think the main takeaway for you listening is just how dangerously deceptive a single broad index number can be.
It really hides the truth.
It does. Hearing that the KSE 100 is up 26% on the year, it completely masks the ruthless internal capital rotation that is happening right beneath the surface.
Because the overarching index is basically a blunt instrument. Technical charts give you a scalpel. They allow you to ignore the comforting headlines and see the actual mechanical flow of the money.
Right. We have market today where established juggernauts like Pakistan State Oil are testing the very limits of their technical trampolines, just watching capital bleed out of their order books.
While simultaneously, we have tech and property stocks like TPLP experiencing these violent high-volume breakouts that clear out entire sections of the order book and push mathematical indicators to absolute maximums.
It is literally two different timelines operating in the exact same market.
And using this kind of localized momentum data completely changes how you research. You aren't just reacting to broad market news anymore. You can physically point to the chart and say, this is the specific 4-hour window where institutional buyers abandon heavy industry.
And this is the specific candle where they aggressively entered property tech.
Exactly.
Which leaves us with a final puzzle for you to mull over as you go and analyze your own screens today. Because these technical indicators, the upward channels, the massive volume bars, the maxed out momentum, they brilliantly capture the what and the when.
We know the exact moment the money moved.
We do. But technical charts only capture the physical footprints of the market. They rarely tell us why. So what unwritten fundamental catalyst, what subtle macroeconomic shift or hidden industry whisper convinced the largest capital holders in the country to violently abandon the safety of heavy energy today?
And migrate entirely into tech and properties on this specific Monday.
Exactly. Finding the invisible catalyst that triggered today's massive capital migration, well, that is the real mystery for you to explore next.